Hello, this is just a brief student loans presentation. I won't go over all of the slides. You can look at some of them on your own just because they're just kind of some different facts and statistics. And I want to try and keep this short for you guys as well. So I will discuss some of this, and I'll also just post it for you if you need to go back and look at things as you complete some of the assignments. So when we start out here with financial aid, there's several different ways that you might receive financial aid. So that's through the federal government, just through your state you live in, the college you attend, or a lot of nonprofit or private organizations as well. So if we start out, sorry, I need to move myself out of the way here. Start out looking at federal aid. These are some of the options that you might get when you fill out the FAFSA. So first, looking at grants, this is money that does not have to be repaid unless you end up quitting school and you were owed a refund, like you had more than enough financial aid to cover things. Work Study, this is a program through which you earn money to help pay for school. And so when I went to college, I got Work Study on my financial aid. Now, this doesn't mean you have to take it, but for it to actually work, you are kind of more or less guaranteed an on-campus job, and they just pay you, through this different fund. It's still just like a regular job. That money comes to you. It's more how the school pays for it. I also found, for me myself, this was a great way for me to get a job. I always took quite a few hours. And typically on-campus jobs are going to be a little bit more understanding if you, just with your weird work hours due to, your schedule of classes, and if you need off because sometimes you'll have tests on a different day or you just need that study time. So I highly recommend, if you do get approved for Work Study, to look for an on-campus job. But just because you don't get this, don't be deterred from getting one of those on-campus jobs either, because there are always tons of jobs that they need help with. And then the last type of federal aid is just loans. So this is borrowed money for college or a career school. It's just like a tech school. And it's obviously something you have to repay, and there's also going to be interest on it. So this just kind of looks at how the different types are funded. So this is something you can look at on your own for these 4 different types. I'll just briefly here touch on scholarships because we didn't talk about that yet. So this, we have a lot of local scholarships in Superior. We're very lucky for that. And so this is a type of financial aid, based on different characteristics of that specific scholarship. And then this is money that you also do not have to pay back. So I encourage you to look at scholarships you are eligible for and fill those out. Okay, so then looking at the federal Pell Grant. So, remembering grants, they do not have to be repaid. These would be awarded to undergraduates who have not earned a bachelor's degree or a professional type of degree before. Student loans. Part of your financial aid offer through the FAFSA. If you decide to take out a loan, make sure that you understand, who is giving you that money. What are the terms and conditions? Like, when do you have to start repaying it? Is the interest going to be, steady and the same, or is it going to be a variable rate interest? Student loans can come from the federal government or even private sources like a bank. And then just a note there, really only borrow what you absolutely need to pay for college. Going into a lot of college debt is probably not a good choice for anybody. It can be really hard to repay that. So when looking at federal student loans, you want to try and take out a loan from the federal government first. Because loans made by the federal government usually have a lower interest rate, and they are typically more flexible with their repayment options. And most often, these interest rates do not change during the life of the loan. One through a bank or something, another private source, have that choice of changing. So looking at 2 different types, we have subsidized, which is backed by the government. you're not going to be getting interest until you actually graduate and start making the payments. So if you go to 4 or 5 years of college, yes, you're going to have that money that you want, but interest is not going to start accruing yet, which is a benefit to you. An unsubsidized loan means from that time you take out that loan, next fall, the interest is going to start accruing. You will have to reapply for the student loan every year, and these terms of the loans often can change. They're not going to make you start making payments while you're still in school, but it's just not going to be one constant thing like a subsidized loan would. Okay, so more with these federal loans. PLUS loans are federal loans that has a graduate student or a professional degree student or even the parent are able to get. So graduate student would be, if you're going to work on a master's, and then professional degree would be something that's going to take more than that typical kind of 4-year time frame. So lawyers, doctors, vets, things like that. The borrower is going to need to have, good credit history. The maximum loan amount is going to be determined by the cost of attending that particular school. And then the U.S. Department of Education would be the lender for this loan. Next, if we look at Perkins loans. So these are, once again, a low-interest federal loan. And this can be for undergrads or graduates. So undergrads, when you're first going to school, 2 or 4 years. That have an exceptional financial need. The interest rate for this loan is typically 5%. Not all schools will participate in this type of loan, so you just wouldn't be eligible to get it is what that means. Your school is considered the lender, and then you make your payments to the school that made your loan, or they might have, some company, a service that does that for them. And then the funds, again, will depend on your financial aid as well as the availability from your college. So those are all federal. Then looking at private student loans. So these are offered by banks, credit unions, other nonprofit lenders. They're typically going to have a higher variable, so the interest rate might change, and fewer deferment options. So deferment is just when does that loan start having to be repaid. Typically with a federal loan, you'll have like 6 months after you graduate. Private loan, it's probably, the very next month after you've graduated. So when looking at student loans, it's important to remember that it's a real loan, just as if you're taking out a car loan, you're going to have to repay it. Even if you're not in the best financial circumstances, as a young graduate, it can often be hard to kind of make all ends meet. Your student loans cannot be canceled just because you don't get a job or you don't finish that degree. So do keep that in mind. So now would be the time when you want to go to Schoology, pause this video, go and complete the assignment for checkpoint 1. So I would pause it. I'm going to keep on with our notes just so we can keep going, and we just have one video to watch. Okay, so now we're going to move on with repayment tips. So, first thing, you really don't want to miss your payments. 1/4 to 1/3 of borrowers are late on that very first payment. So make sure that you are aware of that. Like I said before, usually you have a 6-month grace period, but not always. It also might be just beneficial if you set up an automatic payment from your checking account to make sure you get those paid. Then I'm going to skip that. So the repayment plan, typically you're going to have 10 years to pay that off, which seems like a long time, but if you think that maybe your college might cost you, $15,000 to $20,000 a year, that's a big load of debt. So they're just trying to make it manageable for you to pay. You might have an extended repayment. That's probably more of those professional degrees where it's going to take you more than 4 years to complete. Income-based repayment, so just based on your income, not necessarily what you owe. Lower payment typically. And then a graduated repayment. Initially you have low payments and then they're increased. So kind of saying as you get more into your job, more into the adult world, the payments will be more. So either of these types of repayments are going to yield the lowest payment for most borrowers. So here you can just kind of look at some examples. looking at the loan payment, interest, total payments. This is something you can come back and kind of look at just for your knowledge. Okay, so as you are looking at trying to get the student debt paid off, after you've made your required payments, if you maybe can pay $10, $20 extra, that's going to benefit you, but try and put it towards that most expensive debt first. So that would be your debt that has the highest interest rate. Student loan consolidation. So after graduation, you might want to get all your student loans put into one. Just depending on how things are set up at your school, you might actually end up having 4 different loans, a loan for every year. So that would be 4 payments I'm making. But consolidating them would get me 1 interest rate. I'd only have 1 payment to make, and so that just might be a better and easier option for you. Then looking at loan forgiveness. This is a program by the federal government to encourage young people to consider giving back to society by performing a public service. So like the Job Corps, or oftentimes as teachers, if you work at certain types of schools, low income, high poverty, things like that, and you work there for so many years, they will oftentimes go ahead and forgive that debt that you have. Now, looking at if you are unable to pay your loans, one option is deferment. So that is during a time when you're not making payments on the principal and interest is not accruing. So, for example, with me, every time I went back to school to work on my master's or just get some more hours, I think as long as I'm taking, I'm not sure, 3 or 6 hours, so that'd be 1 or 2 classes, then I'm not making those student loan payments anymore. Kind of the theory on that is obviously if I'm working on my master's, I'm paying for more college, so just trying to help make that, actually a possibility. Then with forbearance, if you are unable to make your scheduled loan payment, but you're not going to qualify for deferment, they might be able to grant you forbearance, which just allows you to stop making payments or reduce your monthly payment for up to a year, but you're still going to be getting interest on that. And then lastly, just looking at bankruptcy. So typically, just because you file bankruptcy does not mean you're going to get those student loans forgiven. That's probably one of those loans that you're still going to be required to pay. So now go back and to Schoology, complete checkpoint 2. And then when you're done with that, there are also an assignment called Financial Aid Scenarios. And that is the end of the notes for this section.